every single one of our major customers and minor customers all shut their doors overnight.
You need the right people in the right place at the right time. And sometimes you have the right people in the right place, but at the wrong time.
I've got to keep going forward. I've got to keep looking for revenue streams. I've got to keep looking for growth, keep looking at new ways of doing things.
But, you know, what's the culture like at the business? What do we stand for, the values?
I've got to tick that box on my personal development program I don't really want to be here.
Scaling up a business isn't easy. If it were, we wouldn't have less than 4% of businesses scaling beyond 10 employees or around £1 million turnover level, and less than 1% beyond 50 employees. But the contribution that we make as owner-managers to our economies is immense and should never be underestimated, yet it can be a tough gig for all of us at times. And only other business owners truly understand the challenges that we face. And through ScaleUp Radio, we aim to help make things a little easier. We interview guests who have been where you are now and may have faced some of the challenges that you are facing. And they offer their thoughts and advice on what has worked for them, as well as what didn't. And we've also combined many of the lessons from these interviews and also through working with hundreds of owner-managers over the last 10 years or so into a practical scale-up handbook that we've called the Entrepreneurial Scale-Up System, or ESUS. And it's for owner-managers like you and me as we navigate our own scale-up journey. And you can order a copy through your favourite online book retailer or by going to all the W's, esusgroup.co.uk, www.esusgroup.co.uk. On this episode of ScaleUp Radio, we got a great presentation and panel discussion, all centered around the 7 financial levers. And you'll also have heard us talking about the power of small change. And briefly, that's around focusing on marginal improvement within your business, small and simple actions over a period of time, consistently having a large cumulative effect. The 7 financial levers are one of the tools that we use to identify a small change that we can enact, specifically within the cash or financial area of the business, but it does go broader than that. And the good thing is that you don't need to be a financial expert to understand these levers. They're very simple concepts that you can discuss with your team or trusted network, and I explain much more about it during the episode. We also cover the process of deciding which cash lever to pull and at what time, and what benefit or small improvement that will bring about in your business, why the length of time that it takes for clients to pay us or how long we give for the clients to pay should be reviewed regularly, along with many other things, and why discounting is generally only a good thing for the client rather than benefiting the business owner in the long term, or the dangerous effects of it. You'll also hear from Dave Perigo from Perigo Consultants, who will give us some insights into the power of the 7 financial levers and the effect that they have had on his business. Finally, there's a panel discussion with a group of great business owners about those 7 financial levers and the way that they all use them within their own businesses and the challenges that they've faced implementing them, but also how they've overcome them and the kind of benefits that they've got from them. And it's an incredibly valuable episode for any small or medium-sized business owner. And I know that you'll find something here that you can immediately put into practice in your own scale-up journey. We're looking at something called the power of small change. This wheel, this coloured wheel, is our model, is the system that we've developed with the 90-day planning at the centre. But then looking at those 4 pillars: strategy, people, execution, and cash, and then the areas that we focus on to make sure that we're driving the things that we need to do, and where the arrow there is pointing at the power of small change. That's what we're going to look at this morning. So you can see it's within the cash pillar. So we're looking at the finances a little bit, but it does broaden out. It's not just about the cash. And you may have heard that the idea of the power of small change being referred to in all sorts of other ways, the 1% margin idea, or the constant 1% improving. And essentially what it's about is about that relentless focus on marginal improvement. So not just accepting things as they are, but always looking and creating a habit essentially within the business for looking at ways that we can improve. And that idea of making a small percentage change over a period of time, lots of incremental small percentage changes adding up to something fairly significant. So we refer to it as a power of small change. Some people you may have heard it referred to as the power of one or power of marginal gains, all sorts of different ways of referring to it, but essentially it's the same idea. And there's lots of examples in business where people have done it, including Mazda, where they had a 1% program on reducing weight loss within the production of the MX-5 at one point. And they challenged every single component essentially, or to make a 1% improvement in the weight gain, and they saved something like 100 kilograms overall in terms of the weight of the car. So it's this idea of small and simple actions over a period of time having that cumulative effect. And the 7 financial levers are one of the tools that we use to help to identify some of those things within the cash area as to what sort of things that we could look at. And the idea is that we're making those small changes. So those 7 levers that we've got here are essentially the key levers that, from a financial perspective within the business, that you can pull on to drive that improvement within the business. Now, don't worry if you're not an expert in financial statements or accounting or financial analysis. You don't need to be, because these are very simple levers in concept that mean that you could have a brainstorm with your teams or with other people and look at ways of improving these. And the idea that we're looking for is that we build this into our 90-day planning. You know that we're very strong on that 90-day rhythm. And the idea is that we build that in so that on a 90-day basis, as a minimum, we're having a review of these cash levers, and we're thinking, where's the one that we could focus on now that would make a difference to the business. So if we were to brainstorm around maybe the cost of goods side of things, what sort of initiatives could we think about that we could then implement an action or two or a tactic or two that would make an improvement. So very quickly going through those levers, and we'll come back to them maybe in a minute, and there'll be time to discuss them certainly in our breakouts. But the idea of, if you take those first 2, the price and the volume, then of course that's essentially giving us our turnover line if we looked at our profit and loss statement. But price is more than just the headline price. Great. If we can increase our headline price, fine. But this is about also the average spend. So can we think of ways where we could increase the average order value that when clients come to us? And similarly, volume is not just about the number of customers that we have. Great, initiatives to increase the number of customers, obviously fantastic, but it's also around increasing the frequency of purchase. Can we encourage them to come back more regularly, more frequently to buy? And if we've combined that with increasing their average order value, then great. We're increasing our turnover without necessarily having to go out and find new customers. But then equally, something that feeds in before your gross margin or your gross profit line is then the cost of goods, or those direct costs associated with each sale. So again, are there some areas there that we could look at that would reduce our cost of sale and therefore increase our gross profit? And that then will flow pretty much straight down to the bottom line. So they're very powerful levers, those first 3. Then maybe a more standard one that we'd all think about doing. Yep, let's look at our overheads, our operating costs, and let's see if we can trim some things off of there, because we all know that as time goes on, we sign up to various things and we decide that over time, maybe we use them less and less. And there comes a point when we should just have a quick look and just maybe cull some of those things. And then we've got accounts receivable and accounts payable. They're fairly obvious. So how long are people taking to pay us? Have we got outstanding payments? Are people paying too late? What can we do to bring those in earlier? Equally on the accounts payable in terms of the cash flow, are we paying too quickly? People are giving us 30 days, and why are we paying as soon as the invoice comes in? Maybe we should just delay that a little bit and manage our cash flow a little bit better. And then the inventory or work in progress. So yes, if we make stuff, then that's fairly simple. We imagine what inventory is, and we can imagine our shelves being full of stock. But actually, it's even if we're in a service business, it's a really important aspect, because this is then more of the productivity and efficiency side of things, of the way that our people are working. Have we got a lot of work in progress where we haven't yet managed to get to the point where we can invoice for it? Are they working efficiently? They're essentially our inventory is that work in progress. So those are the 7 financial levers, which, as I say, if we were between them, they address the profitability and the cash within the business. And we know, obviously, how important that is for a scaling or a growing business. As I say, the idea is that we take a look at these on a regular basis, and certainly at least quarterly, build them into our planning, and then identify specific things that we're going to work on over the next 90 days. Now, I mentioned pricing a couple of times, and one or two of you may have seen me do this example before. But the question here, we've got an example business, just a very simple business that sells something for £10 is the unit price that each one we sell at, but it costs us £7. So our cost of goods is £7 each time we make one. That's what it costs. We're making 10 of them. Therefore, our sales are £100. Our cost of goods are 70. At £7 each, 10 of them means our gross profit is £30, and our fixed costs. If our fixed costs are £20, then our net profit at the end of the day is £10. So the question for you is essentially overall, what's the effect of raising the prices by 20%? So if we were able to raise the prices by 20%, and hold that thought for a minute, because I know one or two of you thinking, it's not that simple, but if we were to be able to raise our prices by 20%, then this is how the numbers flow. And you'll see that actually a 20% raise in our price from £10 to £12 yields a threefold increase in our net profit at the bottom. And that's essentially because we're not making any more. The volume still stays the same at 10. If it does, if we don't lose any customers, stays the same at £10. So we've got no increased cost of goods, no increased overheads. So that 20% unit price goes straight through to the bottom line. But one or two of you, of course, are saying, well, we are going to, what if we lose customers? We can't just do that. In my business, we put 20% price up, we'd lose a load of customers. Now, that may or may not be true, and I'll look at that in a minute. But generally, people do not leave as customers. Customers do not leave because of price. Maybe partly within there, but these are the key reasons, according to a Rockefeller Corporation survey that they did, the key reasons why customers leave a company. If you're doing good service with a customer, it won't be price that's typically the main reason why people leave. You could argue that maybe that 9% customer persuaded to go to a competitor might include price within it. But the main reason is that the customers believe you don't care about them. So if you look after your customers, you're not likely to lose customers due to price. Clearly, there's caveats and limits on everything. But if we work that model through again, and we ask ourselves the question, how many customers could we afford to lose if we did put our prices up by 20% and still make the same net profit at the end of the day? Then in this simple example, we could lose 40% of our customers and still make the same net profit. Now, these numbers may not apply to your business because they are dependent on your particular gross margin levels and your particular overheads amounts and everything like that. But if you work these numbers through with your accountant and work those out, you'll get an idea as to what the real numbers are for your business. But it won't be far off from this. The basic principle will be that actually we could afford to increase our prices, probably, and even if we were to lose a few customers, we're unlikely to lose the number of customers that would mean that we were ended up being worse off. And of course, there's another aspect to this as well. And a lot of us are tempted every now and then to run discounting programs on our pricing. And of course, it works the opposite way from that. The lever again is quite powerful. If we were to drop our prices by 10%, then in this example, this mythical business, we'd need to increase our volume, so increase our number of customers by 50% to maintain the same profit level. So if we ran 10% discount across everything, we'd need to increase our prices, increase our number of customers by about 50%. So you have to be really, really careful about discounting. It knocks your profitability or our profitability quite significantly. So those 7 levers again. So price, volume, cost of goods, operating expenses, accounts receivable, accounts payable, and that inventory or work in progress. And for those of you that are ScaleUp Club members, then what we'll also do is we'll send you this out as well, which are just some key ideas as the sort of things that you can think about doing for each of those levers. So if we were to look at the average order value, the price thing, it's not just about, as I say, increasing the price. We can upsell, cross-sell, might be about bundling, might be about special offers, fine, maybe even bulk offers, but it might be all sorts of things, limited time offers. There's a number of things within there that might act as triggers for thinking, oh, actually, yes, we could do some of those things that might help us to increase our average order value. And of course, scripts as well are a great one of those. If you remember McDonald's, and they do it all the time, but one of the ones at one point was, would you like fries with that? And then it was, is that a large? It's all scripted, but they know that across the whole of the McDonald's franchises, that makes an enormous difference to the turnover and therefore the profits. And then equally on those number of transactions or around the frequency side of things, what could you do? Yeah, could some kind of maintenance program book the next visit in straight away when you sell something. But there's all sorts of other ideas and things around there, including some more obvious things like loyalty cards and whatever. So lots of ideas. But as I say, the basic idea is that every 90 days at least, we brainstorm through some of these, think of some ideas and tactics, and we go, you know what, I reckon if we were to simply book in the next visit every time we made a sale, that would be a good thing, and that would make a significant impact on our frequency or on our number of transactions. So let's implement that. What do we need to do to make that work properly? And let's put that in place. So that's essentially what I was going to cover. And as I said, it's a reminder, a catalyst for discussion, for you to think about what's relevant, what you're going to apply in your business from this. For each of those areas around our ScaleUp system wheel that we have, then we have our in-flight checks. And the in-flight checks that go with the power of small change and the concepts that I've talked about this morning are around, are we focused on continually improving our cash position? So those 7 financial levers, are they understood by all of us within the business, as well as basic financial statements, and something called the 8 wastes, which we cover at a separate session. Do we have responsibility? Do key people within the business have responsibility? Sorry, for key significant line items within the P&L, or is it just a mash of everything? Are we monitoring our changes in cash position on a regular basis and explaining any anomalies, anything that's out of the ordinary? And are we looking, as I said, for at least one cash improvement initiative every quarter that's included then in our 90-day planning? So those are the key checks that we look for when we're talking with businesses about the power of small change, and that are relevant from the in-flight checks. So that's what I wanted to say, and just to cover on that. So that's a little bit of an oversight of if you like, the concept and the way that we look at it. I'd just like to hand over to Dave, who's one of our valued select members, runs Perigo Associates, and just for some insights from his perspective on this whole aspect of the power of small change and the 7 financial levers. Dave, can I introduce you quickly?
Yeah, thanks, Kevin. Thanks for having me on, really, and providing a bit of insight. So a bit of background. I started the business Perigo Consultants around 12 years ago, I guess. Like most of us, I was on the corporate treadmill, had 10 years at KPMG as a tax advisor, moved into a company called Circon, the FTSE's finance director. And I got to the stage, I suppose, where I realised that I wanted to manage my own destiny a little bit more, work smarter, live life, and rather than peddling the corporate hamster wheel. And I guess it's probably a common theme for most people on this call, really, that we want our independence. And we've done something special to, feather our own nests and do something we enjoy doing in life. So what do we do, Perigo Consultants? Well, I suppose essentially we help our clients grow their businesses financially. We're a hands-on tax advisor, so we minimise our clients' tax bills so they can sleep at night knowing legitimately they've saved as much tax as possible and everything's robust and above board. So the biggest issue I have, not the biggest issue we used to have, clients would come to see us, new clients from previous accountants, to say, I've had a cracking year, Dave, but not sure at all where our cash has gone. Where is it all gone? We've made £100,000 profit, but I don't know wherever that can be. And you've probably heard the old saying, turnover is vanity, profit sanity, but cash is indeed king. So I suppose the best analogy is if you're going to road trip to, let's say, Glasgow, you'd basically want to know how long it's going to take to get there, how you get there, and whether you had enough petrol in your tank or not, or electric these days, I guess. So you'd want to know how you were getting there, how much time it would take, and the best route. Businesses are no exception. You want your financial sat-nav. So I guess through part of what we do with Kevin, we're always planning ahead, and part of that's financial. You need to know where you're going, how you're going to get there. And it's no good waiting 9 months till your account's prepared by your bookkeeper, your account FD, to say, this is the profit we've had and this is the tax we've got to pay. You need to really know day on day, month on month. And tools that have helped us over the last few years, things like Xero, QuickBooks, and they're so kind of intuitive now and on the ball. You can literally have accounts on a daily basis, at least weekly anyway. So you will know as part of Bismarck planning, they should have all financial forecasts in place. They don't have to be sophisticated. That's the key thing, really. You don't have to have sophisticated forecasts in place. Just knowing your monthly revenue is enough, your monthly turnover, what your fixed costs are, your salary costs. Just start with the basics and build upon that. And all I'd say is, lean on your bookkeeper, your accountant, your FD. You're all busy business owners doing what you enjoy doing. Lean on the experts to help you and aid you grow your business. So yeah, the old adage is, I've made £100,000 profit, Dave. Where has it gone? And now all of our clients, or most businesses we deal with really, have all got financial forecasts in place. They've got a sat-nav and they know exactly where their cash flow is going to be at the end of each month and the end of the year. And they've got visibility, not so much on this current month's VAT liability, but the next 2 years in advance. They know exactly what the corporation tax will be in 2 years' time, where they're heading, what they're doing, and where the business is generally heading towards. So I'd just like to provide, Kevin can provide, obviously, chapter 9 of his book can provide all the basics, theory on cash flow. But I'd just like to give you some practical tips on what we do and what we recommend to our clients, if that's okay. Just some quick wins, if you like, 4 practical tips on better cash flow. So the days of massive Excel spreadsheets and putting cash flow forecasts together, they're long gone, really. Most of our clients now use QuickBooks or Xero. They're on the cloud, MTD, making tax digital. The account systems work intuitively. And they will link in with a software tool should you need to for cash flow planning. So you might have heard of something called Fluidly or Futurely, and they'll use artificial intelligence. So they'll link into your bookkeeping system. And as long as that's up to date, the rest takes care of itself. The cash flow is in key. You can see where you're going to be in 3 months' time. It works in the background, understanding what your suppliers are doing, what your customers are doing, and it works through your cash flow. With a bit of fine tweaking from your bookkeeper or accountant or your FD, you can get an excellent position whereby you've got cash flow visibility and it works and updates month on month, day by day, really. So don't go down the arduous, tough route to do an Excel spreadsheet, spending loads and loads of time doing those. Use a simple app, as I say, Fluidly or Futurely. They're really good ones that just link in with your existing cash flow or your software system really used for your bookkeeping. And I guess that going back now 15 years or so, people always used to say to me, debtors, massive problem, really. We've got a massive debtors book. Our customers just won't pay us. We spend time and effort on the phone to make sure cash flow is coming in. Our credit control agency helps us out. It's so hard work. Take it in-house now. Make sure you take control of your own destiny regarding debtors and cash collection. You insist you go cardless. Stripe, for example, insist on being paid by direct debit. Take the control back. Don't have a debtors book whereby you're spending admin time chasing debts. It's just passe, really. Get it back in-house. Make sure if clients want to deal with you, make sure they don't have a direct debit or a Stripe basis, really, where you're in control of your cash flow. You pull the cash in rather than the clients or customers put it to you. And one thing I say to all our clients is review your costs every 3 months. take a look, and if costs are in the business and they're not adding value or they're not an investment, get rid of them. I know it sounds quite harsh, but have a good review of things like software licenses, telephones, or your subscriptions. Go through, do a proper job, spring clean if you like, excusing the pun. Review everything, insurance, utilities, wherever you can make a saving, make a saving. Everything's gone up in cost, really. There's so many emails I get now through saying your prices are going to increase by 3%, 4%, CPI, RPI. Make sure you go through everything. If it's not adding value, it's not an investment, get rid of it. And the biggest cost in most of our business is time. The biggest thing, or the most important thing, is know your charge out rate. Go through, understand how much it costs you in the business, how much you generate. If you're generating £200 an hour, £50 an hour, and you're doing something that's adding value to the business, carry on doing it. But if you can get somebody in cheaper to do the arduous or more boring tasks, get them in. I mean, you get a good bookkeeper at £30 an hour. If you don't enjoy doing bookkeeping, get someone in cheaper and better at the job to do it. Virtual assistants, fantastic, adding value. Cleaners, making sure you're spending your time in the most efficient manner possible. Work out your hourly rate and get good people in who are quicker and cheaper than you and love that particular task more. I suppose you could class it in a big organisation as lean management, or Kevin refers it to waste management in his book. Make sure everything in the business is adding value and generating you, profit, really. And wherever possible, if you can, get a recurring revenue model in your business. So a lot of us do work as a one-off and it's not repetitive, but if you can get an element, insurance policies, software licenses, get an element of recurring revenue in, it gives you more certainty, provides you with better control, and gets you a higher business valuation when you get to a stage where you sell eventually. So if possible, getting some recurring revenue. So we use Fluidly, as I said, in our business. It gives us automatic cash flow, and it doesn't cost us anything to provide that to our clients. So if there's anybody on this call that wants to reach out and get a free subscription, no strings attached. It's free for us. It's free to you. Just latch it onto your Xero, latch on to QuickBooks, where it gives you instant cash flow forecasting, and use it with your accountant, you're a bookkeeper. Make sure you're managing your own destiny. We're all very busy business owners, so lean on people like your bookkeeper, your FD, your accountant to nail all these financial things down. Work with them to make sure you've got certainty. And a must read, of course, is Kevin's book, The Entrepreneurial ScaleUp System, which was launched a week or two ago, I think, Kevin. And there's a chapter 9 in there, which is cash. So I won't go into all the theory behind that, but that's an excellent read for anybody. Happy to pick up with anybody after this call if I can help in any way, shape or form. That's me, Dave Perigo. Thank you.
Brilliant. Thank you very much for the plug, Dave. Unexpected. That's great. So yeah, some really good thoughts there. And the control on the cash side is, or lack of, is one of the key reasons why businesses don't scale. And I don't mean scale big, it's why they, maybe don't even get to the point where we might go, actually, what, we've got what we would class as where we want to get to at, maybe 3 to 5 employees or whatever turnover level that we're looking to get to. So, and as Dave says, it doesn't have to be complicated. A lot of us are a bit scared of the numbers, a bit scared of the finances. We don't have to be experts. We just need to do a few basic things really well. And that was great. Thank you, Dave. So, power of small change, 7 financial levers. Who wants to kick off? What do we think? Useful or not?
Absolutely. One of the biggest traps that I fall into is looking for the large, either the large invoice or the large cost to the business to make changes. And I do know over many years of doing it, it's not that. Or if you gross margins down, you'll never find a big invoice, one invoice that is sticking out like a sore thumb. It's hundreds of small invoices that make up that issue. So I've just had it this morning, and something I suppose I'd ask Graham about as well. MailChimp, all of a sudden our audience is increasing, so we've got a cost implication that we keep rising to the next level of MailChimp. But it's like £8.95 a month extra, but that small increase also adds into the large increase in fuel and another increasing heating bills. So everything just increases, doesn't it, all the time? So it's all the while looking at those cost implications and the small levers that you can pull, and what else is in the market. Does it do it at the same as MailChimp, or can it be cheaper? Can you have a negotiation with them? So yeah, you've got to look at it all the time. Doesn't matter how big or small it is. Totally.
Okay, Jeremy, you're good in your dashboards and your numbers. What are your thoughts?
Yeah, I mean, to be honest, I think the main issue for me when it comes to the 7 financial levers is probably not reviewing them often enough. I think we kind of internally, I think we feel like we've got a good control of our overheads and costs, and all our processes are pretty well defined and so on. And you kind of, once you've kind of gone through that exercise in quite some detail, there's a danger of just kind of sitting on your laurels and just assuming it's going to be that situation moving forward. But obviously the commercial landscape does change every once in a while. And certainly at the moment, with rising fuel, electricity costs and dollar exchange rate problems we're having at the moment as well, we've recently gone through this exercise again, and we have identified areas where we can certainly cut on costs or increase prices here, there, and dotted around the product portfolio. So it's definitely something that's worthwhile doing on a regular basis, I think, and not just kind of sitting on your laurels and thinking I've done it once. I'm sorted now, because things do change. Yeah.
What sort of frequency, Matt, then, do we think we should be looking at them?
It's a very keen topic for me, and it's sort of highlighted in my second favorite business book called Legacy, which they, was based on the New Zealand All Blacks, and they said, we got to get 100% better. And they said, absolutely no chance. They said, okay, let's take 100 things and do them 1% better, and that really resonated with me. So I if I wasn't stuck in last month's topic of the owner's trap, I'd be doing it on a monthly business. But I definitely, it needs to be looked at very often, because those gains, albeit small, add up to something really amazing.
Yeah, and that You've just encapsulated beautifully, with the All Blacks example. That is exactly what it's about. It's not, and Rich, as you were saying, it's not so much about finding one thing that makes an enormous difference, one rogue invoice or whatever else. It's finding lots of little things that, when you add them up, do make a big difference, and doing them consistently, so continually looking for that next little bit of improvement. And there's lots of examples. There's the Olympic rowing crew, team 8 from the 2000 Olympics, where again everything they did was about will it make the boat go faster, and they every time they came off the water, or not just on the water, but anything they did, it's like, well, will it make the boat go faster, and what could we do that would be a marginal improvement on that? Peter, what do you think?
So I liked picking up really on Richard's comment. So one of the things that I have thought about is those small things, but equally a lot of the small things in our business now are monthly recurring subscriptions. So actually taking out what looks like a very small cost, actually when you multiply it over the 12 months, actually becomes a reasonably big cost. And actually, so one of the things we did last month was just going through things like people who no longer work here and making sure that we've taken them off as users from all the different technology bits we use. And actually, it's had quite a reasonable impact on the kind of bottom line. So I think also looking at things like when you get paid and when you pay people has a big impact on cash flow in your business. We certainly are very guilty of being very good at paying all our suppliers on time, but not collecting the money in on time. And that's okay if you've got a large amount of cash in the bank, but can cause problems otherwise. So I think just working through the 7 pillars kind of once a month or so is a really useful exercise. Yeah.
And it's interesting, we do a bit of work with some access to finance type people, and they consistently say when they're looking in businesses with certainly a few £100,000 turnover or more, and they're looking to borrow some money to invest in some kit or whatever else, 9 times out of 10 they can find at least half of the money in the business itself, simply by following those 7 financial levers and getting the cash in a bit earlier from people that owe it to you, for example, maybe paying a little bit later, but not over the terms, but, not paying straight as soon as the bill comes in, but also little tweaks on things like your margin. So, yeah, good. Graham, what about you?
It's something that we look at, I wouldn't say monthly, but we certainly review it quarterly. And we've just done, because it was our year end in March, we've had a look at quite a few of our costs. And I think it's like everybody says that when you start to look at things, you think it's a small monthly figure, but when you calculate that 12 times over the year and then add them all up, it is quite can be serious savings. So, we do review them. And we have cut our cloth quite a bit over the last 18 months, which I'm sure a lot of you have. But the other thing is interesting as well is, like Peter said, we were paying people always on time. And then we were looking at our creditors and, they were debtors, and they were taking 60, 90 days in some instances. So we've reined that right back in. Yep. And it's a very positive impact on our cash flow.
Brilliant. Good. Stu, what about you?
I came across a great fact, actually, having to listen to the ScaleUp Club. That in the 1980s, American Airlines removed one olive from every salad they served on their flights. No one noticed, but it saved the company $40,000.
Yeah.
And it's just, there's a whole kind of other, and it just, I think, kind of brought home, it's the little things that make a huge difference.
Yes. Sorry, go on.
Yeah, and so for me, because I run exceptionally lean anyway, because I have to, it is a case of actually, for me, it's not necessarily it's not necessarily about what I can save in terms of finances, but it's actually how could I be more efficient in my time. So actually, if I can do one activity a day that takes and save 3 minutes in activity. And actually, that's actually 15 minutes a week, but actually, it's 1.5 working days over the course of a year.
Yeah.
And so it's not just thinking about the financial aspect of it, but actually, what could I do to sort of rein back on things and be more efficient overall in terms of my time costs as well as my financial costs.
Yeah. Yeah. Very good. All right, Faith. What about you?
We're pretty hot on it, actually. I think in our business, we tend to review everything on a monthly basis when we go through management accounts. So we set thresholds for percentage of overheads versus revenue. So if it's in that kind of threshold, then we're okay. If it starts to creep over, then obviously we take a more serious kind of look at it. Pricing wise, we're quite good at applying cost price increases on a fairly regular basis, not obscene, but again, it's just small things like an annual cost price increase, the revenue that brings in versus kind of not doing it for several years and then having to go for a bigger cost price increase.
Yeah,
we've learned that lesson the hard way. So yeah, we're much more kind of aware of that side of things. And then I think just generally trying to, it's that whole thing, isn't it, of, like you said, Kevin, it's consistency and it's your fundamentals, it's your world-class basics.
Yes.
If you get that right and you constantly, and like everybody else has said, then trying to improve that by even 1%, then yeah, it's going to have a healthy impact on your business overall.
Yeah. And that essentially is what we're saying is, let's make sure that on a regular basis, and it clearly 90 days is the kind of time frame that typically we think about because we're doing these exercises every 90 days and identifying our priorities and our rocks. So every 90 days, we should have a session where we're thinking about these 7 financial levers in particular and identifying an improvement that we could make that might tweak that profitability or the cash within the business. So we could pick any one of those. We could start with pricing. And we could say, okay, well, how could we increase the overall headline price, or how could we increase the average transaction value so that every time somebody buys something, instead of just accepting that, maybe there's an upsell that we could do each time. And McDonald's my favorite example with that is the, is that a large? So what they used to do is just to off of their, if you're ordering fries or whatever else, it's just a tick sheet that they would have, a crib sheet or whatever, and everybody would ask that every time. And just like Stu's example with the one olive, instead of doing 6, they do 5. By asking, is that a large, that over the whole of the McDonald's franchises, that made an enormous difference. And it's that sort of thing that we're talking about here. And equally, you can see what, if you just look at McDonald's, I mean, they're masters at it. They moved on from that now, haven't they, to bundling everything. So it's the meal deals. So you get all of those. So even if you don't necessarily want all of it, et cetera, et cetera. So it's that concept of making sure that we continually look at these things. Use those 7 financial levers just to prompt. It's just a prompt, a catalyst for that discussion as to thinking where you might better find some improvements in the email and the printed things that I sent out to you as well. I did put in a little spreadsheet that's just got a few ideas on them, and they're there again to spark the thinking, not necessarily to say you should do all of these things, but just to give some ideas. So if I just bring that up again here, then what you can see, so you will have this both emailed to you, but also in hard copy. That when it comes through the post, if it hasn't come already, but you've got basically for the seven levers. So if you want to look at increasing the average order value, for example, what sort of things could we do? Or equally, if we want to look at the average number of transactions, so the frequency, essentially, maybe these are some of the things that we could think about doing, because these are tactics that other companies have used successfully. It doesn't mean that they would work in your business, but there's some ideas there, and you might go, actually, you know what, maybe we should simply book in the next visit. Every time that we have a visit with a client, we should automatically book in the next visit, instead of saying, well, I'll tell you what, we'll see you in 6 months. And then in 6 months' time, you try and arrange a meeting, and then maybe it's another 3 months before you get it. Maybe you actually book it in as and when you do it. Or maybe there's other ideas off of this that you could do that would help to improve that transaction value, and also equally for improving gross margin, reducing your fixed annual expenses, or things like retention, conversion rate, and lead prospects. All ideas that just might help spark some thinking. Don't forget to take a look at www.bizsmarts.co.uk to access a great range of resources to help you in your scale-up journey. So that's bizsmarts.co.uk, which is bizsmarts.co.uk.
This has been a Monkey Pants Productions podcast.